A recession is inevitable, not because we're witnessing the end of civilization, but because they are a normal part of the economic cycle. Since the dawn of time, we've had periods of economic expansions and periods of economic contraction. Usually the periods where the economy expands are longer than the periods where it's contracting, but that doesn't change the fact that recessions have to happen from time to time. The big question is when. In July of 2022, the term recession was trending on Google. You would have asked most people what they thought about the economy back then, and they would have told you that we're heading into a major economic crisis. But that marked almost the exact moment where both the stock market and the economy bottomed and began a sustained recovery. Today, investors no longer expect a recession. 45% of investors expect the no-landing scenario without a recession occurring by the end of 2024. And just 17% of investors expect a hard landing where the economy goes into a recession in 2024. Many argue that the recent strength we've seen in manufacturing activity in the US is suggesting the economy is experiencing a big recovery. This is what's known as the PMI, and it basically measures swings up and down in economic activity. When it's very low, like you see here in 2009 during the financial crisis, it means the economy is contracting. When it's very elevated, like it was here in 2021, it means the economy is booming. And when it's at 48, like in these instances right here, the economy is neither growing nor contracting. You can see in 2022, we were right at the edge where the economy was just in contraction. And so many investors think that this was the recession, and that now we're seeing the recovery that follows the recession, kind of like what happened here in 2020 after the COVID recession. But that sounds a little bit too easy. These recoveries in economic activity that you see here don't just happen by themselves. They need certain conditions that can drive these recoveries. This line right here is what ultimately drives the economic cycle. You see, when we shift it forward by 14 months, we see this line predicts what the economy is going to do 14 months ahead. It predicted the economy was going to slow down between 2007 and 2008. It predicted it was going to slow down in 2019, in 2000, and even in 2022. And it also anticipated all of the major economic recoveries we've seen over the last 20 years. If you're wondering what this magical line is, it's none other than the 10-year interest rate in the United States, but inverted. So this may sound all complicated, but it's really quite simple. When this line is going up, it means interest rates are falling and predicting that the economy is going to be strong 14 months later. When this line is going down, it means interest rates are rising, and that's predicting the economy is going to weaken 14 months later. And this isn't a coincidence. Academic research suggests that the impact of interest rates on the economy is felt with around a 14-month lag. So what are interest rates predicting about the economy today? Well, we can clearly see that interest rates today are not yet predicting that we should be witnessing this incredible economic recovery. Quite the contrary, it's suggesting that we probably haven't seen the worst of it, and that economic activity should continue to decline until mid-2025. And although we seem to be in a sweet spot today, between January 2024 and August of 2024, you can see interest rates are predicting that by September of 2024, we should see economic activity begin to decline again. Okay, great, we could see economic activity decline towards the end of 2024, but does that mean anything for the stock market? Well, yes. When the economy isn't doing well, the stock market usually isn't doing very well either. We saw that happen, for example, in 2022, the stock market declined by 25% as we saw the economy weaken considerably during that period. The same thing happened between 2018 and 2020, where the S&P 500 experienced multiple violent corrections during that period. Of course, not to mention the 2009 stock market crash that coincided perfectly with the decline in economic activity. Today, this bounce in economic activity is partly what has fueled this incredible stock market rally throughout 2023 and 2024. If we see that begin to turn around, we would likely see the rally reverse. But as I mentioned earlier, according to interest rates, this period of economic strength could continue until September of 2024. That's still another 6 months away, and in the meantime, the stock market rally could continue. The S&P 500 broke out of a large trading range from 2022 to 2023. That gives the S&P 500 a broader bullish technical structure. When we look at the key moving averages on the S&P 500, all of them are sloping upwards, with the index basically just retesting the 100-day moving average today. This is something that happens many times during healthy bull markets. Additionally, there's a lot more fear in the market today than just a couple of months ago. When we look at something called the NAAIM Exposure Index, we see that fund managers have deleveraged their long positions on the S&P 500 significantly over the last couple of months. You can see in March of 2024, fund managers were leveraged long on the market. This is one of the things we were pointing at to our members to suggest there was a significant risk of a big pullback on the S&P 500, because every time that these fund managers go leveraged long, it makes the S&P 500 vulnerable to a pullback. So for now, that's all we think happened on the S&P 500. Fund managers were leveraged long, were overexposed to the market, and they had to cut back their exposure, and that's the correction we've been experiencing. But now look at where exposure is. Fund managers have dramatically cut their exposure, and that's the moment where we want to start increasing our level of risk in the market, which is what we've been discussing with our members. We're watching some key technical levels on the S&P 500. We're closely watching these on gameoftrades.net. Remember, you can test out our service completely for free.